The announcement of HDFC and HDFC Bank's merger took everyone by surprise. The street on its part gave thumbs up to the merger, with shares of both the financial entities skyrocketing up to 16% intraday yesterday. The merger, if it sails through, will create India's biggest financial behemoth by market capitalization. However, the key word here is if the merger sails through. In an unexpected announcement on Monday, HDFC Bank said that it will completely subsume its sister firm HDFC in a share swap deal. The shareholders of HDFC Limited will receive 42 shares of the bank for 25 shares held, and existing shareholders of HDFC Limited will thus own 41% of HDFC Bank. Shares held by the housing finance company in the lender will be extinguished, making HDFC Bank a full-fledged public company. However, the merger will have to stand the test of regulators, especially the Reserve Bank of India and the insurance regulator.
RBI, if you remember, RBI did not allow Axis Bank to go and buy Max Insurance because it was running foul of RBI's norms of banks holding significant chunks in insurance companies. That's why they have basically said that we want to have a holding company structure, and we would rather that the holding company has is the holder for the stakes in insurance companies, etc. Now, when asked, both of them, they were quite blasé that even here, I think there are precedents, and so we need to see. Because the precedent I would cite is Axis Bank not being allowed to go ahead with the Max merger. So why should it be any different? So what I'm saying is that why should RBI carve out special dispensation for HDFC Bank? So there will be an overhang in terms of on the HDFC life stock.
Back in 2020, the banking regulator did not allow Axis Bank to single-handedly own a significant stake in the life insurance firm. This precedent, analysts believe, could prove to be true for HDFC-HDFC Bank merger as well. Presently, HDFC owns nearly 48% stake in HDFC Life. If the combined entity owns a bigger share, the merged entity might have to pare its stake over the next 15 to 18 months. Currently, banks can either own more than 50% stake in an insurance company, but they have to trim down the stake over a period of time. Moreover, RBI has been mulling a cap of banks' ownership in an insurance firm at 20%. All these regulatory requirements, analysts say, will have to be watched. That apart, analysts say investors need to be cautious as far as FPI inflows in the merged entity are concerned. This is because domestic mutual funds right now can hold 10% of their entire corpus in a single entity. The third overhang could be on the financials. According to early estimates by global brokerage Macquarie, HDFC Bank will have an excess SLR/CRR asset requirement of around 70,000 to 80,000 crore rupees and will need an incremental 90,000 crore rupees agricultural portfolio to meet PSL norms. These low-yielding portfolios, the brokerage says, could be a drag on the merged entity's P&L. Refinancing HDFC Limited's funding with low-cost deposits will be another key factor for the success of the merger. Analysts fear HDFC Bank's effective CASA could go down to 35% from 47% post-merger. Investors therefore should be patient in order to accrue benefits from the proposed merger.
If you look at the outstanding loans of HDFC Bank and HDFC Limited, you get a 50% upside straight away. From about 13 lakh crore of advances of HDFC Bank, with the merger, it can go close to 19 lakh crore, 19 trillion rupees. So, in the market, the size always gets a better valuation. Second, if you look at the banking credit growth, which used to be in double digit several years back, now it came down as low as 5% during pandemic. Now it has picked up to close to 8%. But still it is in single digit, and there are no visibility of this hitting double digit soon. But if you look at the housing loan segment industry, it is most of the time it is in the double digit. So going forward also, the housing loan can continue to grow in double digit, which means HDFC Bank can improve its credit growth further. Of course, it is outstanding performance within the banking industry. We saw today 21% loan growth of HDFC Bank. Now, with addition of home loan business, this credit growth can be much faster than even 21%. Third, HDFC holds about a 25% stake in bank. So obviously these shares have to be extinguished in my understanding. And if that happens, it will be EPS accretive, a book value accretive for HDFC Bank. So therefore, from all these three perspectives, I think it's a great opportunity, beneficial opportunity for shareholders of HDFC Bank.
From a valuation standpoint, analysts say HDFC Bank's valuation can jump from less than 4x price to book value to 5 to 6x price to book value in 1 to 2 years. Against this backdrop, the two stocks movement will yet again be the key driver for the markets on Tuesday. Besides stock-specific action, and other global cues will guide the indices. The benchmark S&P BSE Sensex and the Nifty 50 indices ended above their key psychological levels of 60,000 and 18,000 yesterday, sharing the merger.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.